Because Iran is charging ships $2 million to cross the Strait of Hormuz, a waterway controlling 20% of global oil, the war has shifted from military confrontation to economic leverage. Tehran's ceasefire demands include a permanent toll modeled on Egypt's Suez Canal fees, but without the justification of a man-made waterway. Only 2 vessels crossed the strait on March 24, versus a typical 150 to 160 per day. The IAGC is not negotiating to settle. It is negotiating to establish a new pricing order for global energy, payable in yuan. That last detail, yuan-denominated tolls, strikes directly at the petrodollar system that underpins America's reserve currency status. If accepted, even partially, it would hand Tehran a recurring lever over Western energy costs, independent of the war's outcome. That leverage is already translating into recession math. Moody's Analytics now puts 12-month recession odds at 48.6%, up from a baseline of 15 to 20% before the war began. Goldman Sachs places it at 30%, EY Parthenon at 40%. The transmission mechanism is oil. Brent crude peaked at $115 per barrel last week and has retreated to around $89 on diplomacy hopes. But Moody's chief economist Mark Zandi says prices only need to average $125 per barrel in Q2 for recession to become more likely than not. The IEA puts the current crisis in starker terms than the 1973 Arab embargo. The world is losing 11 million barrels per day versus 5 million in 1973 combined. The Strait of Hormuz is also the choke point for a third of global fertilizer supply, meaning food inflation follows energy inflation by roughly 1 harvest cycle. Trump's economic approval has dropped to an all-time low of 29%, below Biden's floor of 32%, while 40% of Republicans now disapprove of his handling of inflation, a constituency fracture that constrains his negotiating posture with Tehran. Meanwhile, a different causal chain was breaking through the semiconductor market. ARM Holdings surged nearly 20% after unveiling its first in-house AI chip, projecting $15 billion in revenue by 2031. The mechanism matters here. ARM built its business licensing chip architectures, collecting royalties from every device that used its designs, including from NVIDIA and Qualcomm. By moving to sell its own chips directly, ARM is vertically integrating into the market it formerly enabled. Its first chip targets AGI-scale inference, with Meta Platforms confirmed as the lead customer. That partnership is significant because Meta's goal of a $9 trillion market cap by 2031, embedded in executive option grants that only pay out at $3,727 per share, requires a massive reduction in AI inference costs. Owning the silicon layer is how companies like Amazon and now potentially Meta achieve that cost reduction. The collateral damage falls on memory chip makers. Google's reported breakthrough in AI efficiency, which may reduce the data storage footprint of large models, sent Micron and other memory stocks sliding. Less memory per inference unit multiplied across hyperscale deployments compresses the addressable market that memory suppliers have been pricing in.
The ARM-Meta relationship adds a further dimension to Meta's week, which also included a California jury finding Meta and YouTube liable in the first successful social media addiction trial. The $3 million compensatory verdict is less relevant than what comes next, punitive damages, determined after the jury found both companies acted with malice. The case was a bellwether, meaning its outcome shapes thousands of pending suits. Meta consistently argued that the plaintiff's mental health issues predated her social media use, but the jury only required that social media was a substantial factor, a lower standard that now applies across the entire litigation pipeline. Meta's stock rose about 1% on the day, partly because the $3 million figure was smaller than feared, and partly because the company simultaneously announced layoffs of hundreds across Facebook and Reality Labs. The market read those cuts as discipline, a signal that the $9 trillion ambition comes with cost controls, not just capital deployment. But the legal overhang is structural, not episodic. 3 conditions will determine how these chains resolve. If oil stays below $100 per barrel through Q2, sustained by diplomacy rather than a genuine reopening of the strait, recession odds compress and NVIDIA and other AI infrastructure names recover, as Wolf Research has argued. If the strait remains functionally closed past May, $125 oil becomes the baseline, and a second-half recession becomes the central scenario, not the tail risk. On the chip side, if ARM's in-house chip gains additional hyperscaler customers beyond Meta, it signals that the architecture licensing model is transitioning to direct competition, a slow-moving but structural shift that would reprice royalty-dependent revenue assumptions across the semiconductor supply chain. And if the Meta liability verdict produces large punitive damages in the coming weeks, it reopens Section 230 reform as a legislative priority, with implications for every platform that monetizes engagement through algorithmic feeds.